Thank you all for spending your lunch hour, if this is your lunch hour with us. I am Aude Montoya Baker, and I am our Employee Housing Programs Coordinator. And with us, we have Amy Kennedy from Brothers Redevelopment, and she's going to give us some insight on combating the challenge of affordable homeownership. Thanks, Amy. I will turn it over to you.
Good afternoon, everybody. The name of our presentation today is Combating the Challenge of Affordable Homeownership. It was already a difficult process in Colorado before the interest rates increased. So it's as much of a challenge or more these days. So hopefully some of these takeaways will help everyone understand there are some options available that might minimize that impact of that interest rate increase. We want to just spend a little time going through 3 different topics that would be of importance to understand in the realm of seeking home ownership. Topic 1 is the down payment assistance programs that are available. This is a tremendous help for a first-time home buyer. Definitely, please check into these, and we will go into some detail here on these. The down payment assistance websites are very important. I have them listed here. They will also be at the human resources, employee human resources area, where you'll be able to see a copy of this presentation, and that way you don't have to worry about writing these down right now. I encourage everyone to go to each of these websites. That way they can understand all the attributes that are available, and just sort of learn more about each of these, because they each have a different spin to them. We are going to talk more about Metro DPA, more about Impact Development Fund, and then most folks that have delved into home ownership have heard about CHFA, or Colorado Housing Finance Authority, and there's 2 different programs that they offer, and the uniqueness to them is that sometimes they will also partner with these other down payment assistance programs. This chart will help us understand some of the specifics regarding these programs. Metro Down Payment Assistance, or Metro DPA, and by the way, all of these are available in Larimer, and most of them are going to be available in Weld as well. Weld as well, sorry. So Metro DPA, it requires a 640 or higher credit score. They ask a person to reside in the home for 3 years, and it's forgiven 1/3 each year that you live there. So 100%. First year you would have to repay if you had to sell right away. Second year, they're going to be looking for 2/3 of that to be returned. Third year, 1/3. And after that 3rd year, that money that they helped you buy the home with is a given or becomes your equity. So the Metro DPA, one of the reasons why it's so good to look into this one is you can see here that the income requirement is quite high. And some of the other programs are more limited to the amount that you can make. So this one is not factored on what they call area median income. It is regardless of how many household members. The income limit maximum is $176,700. It helps with 5% down, which is quite a sum of the purchase price. They do not charge interest on this money. It is what it is, so they're not going to make money off of this if you do have to repay it, and they're not going to charge any while it's sitting there. So whatever the 5% is the amount that you will either be forgiven in 3 years or have to repay back if you sell in 2. Metro Social Equity Program, That is available. It's sort of unique. So this would only pertain to people whose descendants lived in a redlining area in Denver. Now you might say, well, how's that going to help me in Weld? If your descendants lived in the redlining areas of Denver between the year 1934 and 2000, then looking into this program, say you have grandparents that lived in Highlands, you'd want to look at that map and see, because it could benefit you even in Weld County for as much as 25,000. If you guys think that you might be a good candidate for that, you'll have my email address. If you want some help figuring that one out, more than welcome to help some people. It's pretty exciting. And don't just assume that you might know the areas that were redlined, because a lot of even parts of Cherry Creek, which is quite substantial now, people were victimized by the redlining. That was an illegal loan process from 1934 to 2000. Um, uh, so that is only available for BIPAC, and so the target recipients are going to be Black, Indigenous, and people of color only. Still very much worthwhile checking into. As I said, 25,000 is a big chunk. So then there's the Impact Development Fund. This one, some of the attributes would be, you have to have mortgage ready credit. You have to go to First Bank for that and use their program. The benefit can be as much as 5% or up to a total of 30,000, whichever is less for the price of the house. You do not need a full 3% of your own money for these programs, so it can be a really good way to look into purchasing. Now, they also have a second program. This one is going to be also available for non-urban areas. So that's sort of a really nice attribute. That means that, if you want to live outside the city limits of Fort Collins, they will go up to 100% of the area median income. So again, just going to that website that I furnished on the page earlier will tell you all of the attributes and all of the requirements. Sometimes it's really good to just go ahead and delve into it, talk to First Bank. If you're not sure that you might qualify, always worth trying. Again, I'm just a housing counselor. I work for free. So if you want some help understanding any of the lender requirements or anything, and you just want to bounce it off somebody before you call a lender, feel free. So then we move over to the CHAFA programs, and they have two of them. One is down payment assistance, and the other one is a second mortgage program. And so each of them are sort of unique. As you can see, 3% of a purchase price for the down payment, 4% in a second mortgage, and that is also interest-free. So it sort of depends what you need to do. Do you need help with the down payment, or do you want to lower the mortgage amount that you're borrowing and paying on? The second mortgage sits out there, and until you've paid the rest of your 30-year first mortgage off, you don't have to worry about paying the second mortgage. So it can work really well as an option. Just some takeaways. CHAFA, down payment assistance, requires an approved CHAFA lender. However, many of the CHAFA lenders are also Metro DPA approved, and something like First Bank is going to be approved, so that you can combine some of these programs for the best benefit. So each one has their own approved lender list, and you can find that on their website. But you can also check with the person. If you have someone that you have worked with in the past or a friend has worked with, and if they're not used to using down payment programs, you may want to really consider going back and looking at the approved lender list, because there is some extra work involved, and those that are trained can help you move through those paces really well. All of them require a home buyer education class, and some are going to require different home buyer education classes. So always good to just check in. Jaffa requires their own program. Some of the other lenders have their unique programs as well. Topic 2, we're just going to touch on land trust and the options of Habitat for Humanity. Now, these are going to come with income requirements, and we're just going to spend a little bit of time here understanding what a land trust is. For those of you that are not used to this concept, basically when you choose to buy in a land trust, you're buying the home, you're not buying the land. And therefore really reduces the cost of the home. In Colorado, a city lot can easily be $200,000, $300,000. So the cost of the house might come from $520,000 down to $320,000. You know, that's going to be worked out between the land trust provider and the way the appraisal is done. Some of the pros to that, of course, would be that your loan amount is going to be a lot less. And it's going to sound confusing, but lenders use the entire value of the property for the most part. So they're going to include that lot. And so lots of times in a land trust, you don't have mortgage insurance because you're actually getting the property at a lot less loan to value. Land trusts remain affordable for present generations and for future generations. So to some people, that is a con, not an attribute, because if you were to purchase a land trust home and decide to sell it in 3 years, you're going to be held to what's called the resale formula. The resale formula is going to limit the amount that you can make when you sell that, to keep that in the affordable housing realm forever. Now, some people see that as an attribute. They're like, oh yeah, this is cool. I'm buying a home that will forever be affordable. So the next family or next homeowner that buys it is going to have a reasonable purchase price as well. Now, in saying that, I want you to understand that every dollar you pay towards that mortgage amount that decreases, you know, say you borrow 200 and when you go to sell it's at 150, then that 50,000 is always yours to recoup. It's just the amount of the appreciation in addition to what you purchased it for will be driven by this resale formula. You know, something to consider. Oh, I just want to buy this home for 3 years. Then maybe you don't want to put in a new quartz counter. If there's a nice counter there, you maybe want to leave that counter because the cost of that quartz counter might not come back to you if you resell it quickly. If you're going to live in the home forever, then do what you want with it and will it to your children or your heirs, and you know, it's your home, so it doesn't matter what you resell it for because you're not going to resell it. Just things to consider. The land trusts always have what's called a land trust orientation. You can even take those for free. I'll point that out here, meaning that if you're just interested and want to know more, it's great to join in on an orientation, and they cover the resale value. They cover the same things that I'm covering, but much more in depth. So let's see, I probably have actually hit on most of these. I work with a land trust. I'm really enthusiastic to what that can do for home ownership. It really makes a person who's been trying to put together the process for a, say, $400,000 mortgage, bringing that back down to 260, 280, 290, something that's still a reach, but much more affordable. So, so yes, we've talked about everything on this particular slide.
Amy, just two quick questions that have come up.
Sure.
If you purchased a home through CHFA 15 to 20 years ago, are you eligible to apply again?
I believe so. If you have not owned a home in the last 3, that's going to be the deciding factor. If they still own that home, then they're not a first-time home buyer. So most likely, uh, what would be interesting for them to delve into is, even though CHAPA is the owner of their mortgage, they would have applied at a direct lender. And so they may be able to go back to that same lender that they actually had their application at, that sold them the CHAPA program or the product. If they need help understanding that, they sure could email me, and I could go into more specifics on how to hook back up with that original lender from 20 years ago, if they're still in business.
And then can the Metro DPA program be used if you are getting a conventional loan?
Yes, yes, most definitely. In fact, that's probably one of your best options. Um, the least amount down, and lenders are able to provide that. And with the with it being a conventional loan, then over time, if they do have mortgage insurance, it will drop off automatically, rather than having it for the life of the loan. I wanted to bring out Elevation Community Land Trust and just a couple of amazing details. Um, Basically, they've been doing a lot of lending in Larimer County, and it's really exciting type of a land trust. It's not held to one specific area. This particular land trust, you're able to buy all over, wherever you would like in Larimer County. So it really adds the options. You might be the only land trust home in a subdivision. You're not going to be sitting there with land trust homes on every side. Um, so, it's great to know that we're going to talk about their income limits, the assets that they also limit, because they're not going to let you have a loan if you have a certain amount in an institution that you're not willing to use into the home. So there is an asset limit on this program as well. You can combine down payment assistance, Metro DPA, using this land trust. Again, you just want to make sure the lender's approved at both locations. And then, as I mentioned, the free orientations. In this particular case, ECLT offers it in Spanish or English. So this was some information that I pulled from their website. The average price of the home that they have lent on in 2022, or excuse me, 21. Sorry, it was $216,000, and the average price of a home in that same market is $540,000. So it's quite a dramatic difference in that loan amount, and brings in a lot more people to be eligible to purchase in a land trust. These were some of the statistics. Well, let's talk about the left side. This shows you for one person, the max income, and this figure is 2022. That will stay the same until the end of March, beginning of April. They'll have new, what they call updated area median income figures. So that'll change very slightly, but it hasn't changed more than $1,800 in several years. So one person, 60,100. And then, just giving you a range down to 6 persons. It doesn't stop at 6 persons if you have an 8-person household. I just didn't want to make the chart go forever. But it shows you the amount of income, the maximum that you would be allowed to make and still qualify. But it allows you to have, if you have a 401k and you don't want to use it, if you have 55,000 or less in it, it still allows you to move forward and be an approved candidate for a ECLT or Elevations Community Land Trust applicant. Now, these figures are specific for Larimer County. So if you were to delve into a different county, you would want to get those figures. If you need any help locating them again, reach out, and I'll be glad to pull that chart for you. I wanted to show you this little pie chart on the right. It was quite impressive to me. The blue is Fort Collins. And so out of 299 homes that they put together for 2021, into their land trust, 99 of them were in Fort Collins. And, that's a real strong number. That's exciting to me. They were having difficulty at first getting started. And so that tells me that they're really starting to roll. And it really brings the price in to making it more affordable in this time that we're in. Let's see here.
Amy, while you're moving to the next thing, there's one other question. Are there
Sure.
restrictions on any of the down payment assistance loans or programs if you're not a permanent resident or a green card holder?
Let's see, Metro DPA will allow for a person with an I-10 number to apply. The other programs, CHAFA and let's see, I got to get the letters right here, IDF. Those both require they'll accept a dreamer, which is sort of in a no class other than a dreamer, but they will not move forward with an I-10 number on that program with the down payment assistance. Now, First Bank can offer an I-10 loan to someone who is undocumented except with that I-10 as long as they're a self-employed borrower. Meaning that if they own their own landscape or construction business, concrete, and they file with the IRS using that I-10 number, then they would be able to apply for a loan with a First Bank and get a reputable, good loan. I know that because in our land trust here in Denver County, we're not specific on being either a permanent resident alien or a citizen. So we allow in the very much smaller land trust that I work in daily to allow persons with an I-10 to join. Let's see here. Are there any other questions so far?
Not right now, thank you.
Okay. So this is another program that's coming to ECLT, Elevation Community Land Trust. They don't have much on their website, but it looked pretty exciting. So be sure if you go to that website, check out our doors opportunity. When I clicked on it, it just basically had very little information, but said, it was working on it. So imagine any day now, it could be a similar increase. Perhaps it's also using some sort of redlining map or something that's that they've come up with to add to the down payment. You basically still have to qualify in the normal process. So if you're interested, they make that website really easy. So check it out. You can virtually just find a world of information there. And if you have any questions, once you do, feel free to reach out. Habitat for Humanity, Fort Collins. This also has income requirements, and that we'll show you here in a minute. They offer the application process only once a year. And so that's the hardest thing, is to remember or to remind yourself when to apply, okay? What I did notice on their website was that they offer the opportunity to sign up via email, and so you can get a notification when they open it up. But just so that you're aware, it's closed for right now, but it does open December 2023. And check it out. It looked like a really beautiful little spot. Now, this all appears to be in a subdivision of Habitat housing. I just want to sort of reiterate, there is a misconception that you have to be a Christian to apply, and that is not a factual fact for Habitat for Humanity. It allows all people to apply, as long as your income works in per year, the number of in your household, and I'll show you that. But there's a real good facts and question FAQ there on that website. I suggest reading through that. There's just a lot of good buzz with Habitat for Humanity. It does require some volunteer hours into your house. However, I've worked with persons with disabilities, and it will allow you to do things based on your disability to help. You don't have to always be the one out there with a hammer and the nails. There's all sorts of things that they will allow the volunteer to do, or the applicant to volunteer to do. This is for Fort Collins, and as you can see, this is annual income before taxes are taken out, so that's your gross income. Again, that one person, and you can see it goes up to the 60,100. So, and then it breaks it down to the month. I'm not sure, it's just part of their website why they would do that. Perhaps it's easier for people to figure that out. But when in doubt, encourage you, go ahead and apply. Everyone critiques income just slightly different, including lenders. So, never think, oh, I'm over. If you're very close, please go ahead and reach out and see. Again, if you have more than 8 people, their chart does go up higher. There's also a Habitat for Humanity in Loveland. It is a different organization. It also has a email reminder that you can ask to be reminded when the application opens. It is also closed for the time being. I think, let's see here. This website also shows just some exciting new homes. I looked, and as you can see, they had just recently opened one new home on January 28th. And there's, this is the family. And there's a couple of pictures. I don't Facebook, so I couldn't get in very far. But if you are a Facebooker, they have a good Facebook site to see some of these homes in their community. Their income is a little different, so I put it up here. They show, a max and a minimum. So you do need the minimum income as well. And then they broke it down to hourly. So, that tells me they're going to probably be looking mostly to your hourly wage. So if you receive overtime, that's going to be one of those gray areas to reach out to them about. If the overtime puts you up but isn't guaranteed, they may not have to count it, one of those things. So, keep in mind, probably worth investigating more. By all means, check out their website. Our third topic today is some examples of open loan products and how they can equate to savings. Now, I have to just sort of warn you on this topic. This one's sort of big. This could be a webinar all on its own. So again, anybody wanting individual help, please reach out. If you want to fill out the survey at the end and you have interest in more of these products, sort of honing in on these individually, be sure and let us know that. So we're going to talk a little bit about FHA, VA, and USDA, as well as the conventional loans. And kind of spin the products a little bit to tell you some hidden information on each of these that might bring that affordability or combat that affordability crisis with the interest rate, bring things into par. FHA loans require 3.5% of the borrower's own money. So just want to point out conventional loans, first-time homebuyer loans, that's 3% down. So for a conventional loan, you may actually have less of a down payment. You can actually quite often save on down payment or on closing costs as well on a conventional. FHA is a good product if your credit score is a little marginalized, meaning, if it's down at the 640 realm. It will help people apply for that product a little easier. However, don't let a lender just steer you to an FHA loan if you're a first-time home buyer, like, oh, first-time home buyer, FHA loan. And just so you know, you have the right to ask for, hey, can I be reviewed for a conventional loan first? And if I don't qualify, then maybe look at the FHA loan. If you want to save a little bit of money in the long run. FHA requires what they call an upfront mortgage premium at closing. So there's a fee you pay to close the FHA loan, and then you also pay a monthly amount towards your mortgage insurance, and that stays on the life of the loan for most people. So it's a loan that once you get it, you will be paying the mortgage insurance for the 30-year time frame. I did get an announcement this morning from HUD, from our vice president, who said they're going to be cutting the fee. It's a fancy way to say 85 basis points was the old figure, but they're going to bring it down to 55 basis points to be paid at closing. So it purported that you might save as much as $800 on the average loan closing. I'm not sure. They didn't say the purchase price they were using because it's going to be based on a purchase price. So we can talk one-on-one on that if you end up in that category of looking into a FHA loan. It is a good, reputable product. It does last the same for 30 years, the principal and interest. So if that's what the option is and you want to be a homeowner, don't shy away from that loan. It can still be an excellent way to get your foot in the door. Let's see here. VA loans. I like to talk about VA loans. I know there's veterans out there that don't take advantage of this product. And just so you're aware, as a veteran, you would not pay mortgage insurance at all. That is an excellent savings. You also aren't required to put a down payment down. So you still can use down payment assistance. You still can bring that loan amount down by that down payment assistance, but it doesn't take out of pocket money for you as the down payment. Now, the fact that the Veterans Administration guarantees your loan 100%, the underwriting guidelines can be more lenient. But this is my cautionary statement. If you're a vet and you want to go in and apply for a veteran loan and you talk to a lender and they're immediately trying to talk you out of taking advantage of what is your right, go to a different lender that's used to VA loans and tell them to, oh, hey, I want to compare my VA loan with a conventional, and you send me closing costs and what it would cost to close on both of these loans. And they can do that for you in a heartbeat. Um, you served for us. This is one of those things that's guaranteed, and it's a great benefit. I just want to, basically thank you for your service and know that well worth your time and effort to pursue that as a choice. A conventional loan, like I said earlier, is sort of a misnomer loan, meaning or misinformation out there that it's difficult to apply for, and they really aren't. My previous history as an underwriter, I made decisions on loans on a daily basis. Conventional loans are great first-time homebuyer programs available. Just, be sure and find that person that you want to work with as a lender that can also help you with down payment assistance and take advantage of both the mortgage insurance if you end up with a 3% down loan. A conventional lender has to drop the mortgage insurance when you reach 78, I think it's 78.33% loan to value. Or you can petition them at 80% when you know appreciation's happened and increase the value of your home and your loan amount as you're paying is coming down. You'll be able to drop that mortgage insurance and reduce your monthly payment quite significantly by that cost. See, and there's no upfront MIP or mortgage insurance paid at closing. Now, I did want to just mention to everybody real quickly about buy downs because they're the hot topic right now. Many people are using down payment assistance to buy down their rate. And this gets pretty tricky. We really can't cover it in just a few minutes, but there's all sorts of buy downs out there, and you just have to be careful when you're marketing yourself to get a good loan. Basically, these would not be available for an FHA loan. You're not allowed to buy down your rate for FHA, but for a conventional loan, let's see, for instance, to buy down a rate, let's just make it up today and say rates are 6.25% for a 30-year fixed, and you're going to do a 2-1 buy down. That basically means that your first year's interest rate would be 4.25%. You bought it down 2 points. And then after that first year, the second year, it's going to be 5.25%. And then in that third year, you're going to be paying the rate that you closed at, which is the rate that will appear on the note you sign at closing, would be the 6.25%. So basically, whoever funds the 2-1 buy down, you set that money, that chunk of money, and that's going to be based on your lender, but let's just say it's 2%. So we're just going to make up that the purchase price is $200,000, and the 2% would be $4,000. And usually it's a seller. You can get the seller to pay that cost. If you're the one paying that cost, then say you've applied for Metro DPA and it's coming from down payment assistance, that money's going to be set aside by that lender and put in a separate account. And every time you make your payment for the first 2 years, they're going to pull from that account and make the whole amount. Pull, make it, pull, make it. And that's how a 2-1 buy down works. Now, I did see there's some language out there for a 3-2-1 buy down. Just be very careful when you shop around that you're getting a good fixed rate conventional loan sold to Fannie Mae or Freddie Mac. There's people that think they're quasi-government. They're very close to government loans and they do work with the government. However, they are sole proprietors. They own the companies themselves. So Fannie Mae is Fannie Mae, Freddie Mac is Freddie Mac. Um, so there's also something called a permanent buy down. And that would be a permanent solution where it's an even larger amount, as you can imagine, but you're permanently buying down that rate for the life of the loan. Those are done sort of rarely. I've got to admit, I'm getting so old that I bought my first house in Jimmy Carter days at a 14% for my first loan, and I bought that rate down to get it to 14. So, just keep that in mind, that even though the rates seem really high, still there's some avenues around being able to combat that rate, even if it's for a couple years. As a mortgage underwriter in my previous history, people who uh, say you just completed 4 years of college and you are starting a job and you're also going for your master's on the side there, and your income's going to increase, doing a 2-1 buy down might make a lot of sense, because you're starting at 4.25, and most likely once you receive your master's, your income's going to climb up. It's just that you have to have an awareness that if you do a 2-1 buy down in a couple of years, your payment's going to increase. And so you just sort of have to be prepared for that. So I think I've covered, let's see. So, basically it will allow you to qualify on some products. On other products, loan products, they're going to still qualify you at 6.25. So, it's just one of those things. It's mostly done for the impact of what you pay monthly, not so much the impact of what you're going to be qualified at. USDA loans. I like to talk about these just, let's see here. Oh, I better talk fast. Basically, these loans are only available in rural areas. And you might think, well, that's certainly not going to be the city of Fort Collins, the city of Loveland. So you have to be careful when you're researching to buy a property, and make sure that it is able to be lent on in with a USDA loan. So quickly here, the type of loan this one can be originated, not to be confusing, but Chaffa themselves, with those 2 down payment assistance programs, offer USDA loans as well. So you could combine those. Metro DPA, they would also be able to still help with the down payment assistance and a USDA loan. So you just sort of have to do your shopping, and if you need any help with that, again, I'm available. So I just want you to know, this is a product that originates with a lender. There's a second type of USDA loan, and we're not going to get into that today, but that one has very, very low income, and you literally have to go to USDA to acquire that type of product, and it's going to have a subsidy. So, again, if we have more time in the future, we might do something to explain that product, but that one's very complicated. But this one, the lender will charge you 1% to guarantee this loan. USDA, you'll be paying them 1%. There's no mortgage insurance. The map here, I will show you. Now, let me just turn the page here. This home that I'm showing you here, when I turn the page, I'll remember what town this is in. But basically, I went to Zillow and I saw what was for sale in some of the areas that Audra helped me find. And I looked up to find viable homes. Now, of course, we all know with the market, this one's probably gone already, because I think I did this 3 weeks ago, but this one here that you're looking at, even though it's in a very small town, would be a USDA eligible home. I did it on the 9th. Some of these homes are in Eaton, Alt, Pierce, Nunn, Livermore, and Red Feather Lakes. Now I know, Livermore and Red Feather Lakes, Larimer County, they're going to be quite a distance, but many of us work from home now remotely and only travel a couple of days a week. I included those. So these are just some examples of Livermore is here in the right-hand corner. I'd have to go back and see which town has these really nice little houses. Most likely, like I said, you can spend a lot of time, looking at the homes for sale and taking them over to the map to see if they qualify. And you'll have to have everything down to the exact address. And then you'll also have to have the zip code, and it'll tell you, yes, eligible for a USDA loan. And then, when you go to that lender, you can say, I've already checked the map. This one appears there. I'd really like to see what the closing costs look like. And you always have the right to ask for two loan approvals from the same person. And I really encourage it. Because you're not going to hurt your credit to do that. You got the same lender there. Programs have different closing costs. So the USDA is going to cost you one amount to close, and a conventional with 3% down is going to cost you another. And it's your right to ask for more than one critique of a loan product. And you get 3-4 days to decide which one's best for you. So let's see here. So as far as 115%, I just wanted to sort of show you what those amounts looked like. Of course, again, if you have a household of 5, you're just going to go to the 100% and add 15 to it, and you can keep going here with the amounts. So for Weld County, let's just say 1-person household, 79,710 is the maximum. And again, if you're on that brink and you have overtime or a bonus that you're not sure is going to be likely to continue, always we're still asking for someone to review your income if you're borderline. For Larimer County, all the way up to 92,944 for 1 person. So, quite the ability to have income coming in and still qualify for a USDA loan. So. So I'll just ask Audra if we have any more questions.
There are 2 more questions in the chat. One is, if you do the Metro DPA, does that require mortgage insurance?
That's going to depend on if you have 5% down and you have some to put down as well, you're still going to be most likely, if it's a conventional loan, above 80% loan to value. So it would require mortgage insurance. However, it's going to be a lesser fee. Not to get too complicated, but mortgage insurance has its own chart. So it charges you per $100 a certain rate. And so if you have a credit score of 720 to 780, it could be, 0.50 at 95%. And then if you drop down to 92%, it could be 0.36. So you would definitely still save money by using the down payment assistance in conjunction with your own money to bring it down as low as possible. And your mortgage insurance then would be adjusted downward in cost.
And a quick shameless plug about mortgage insurance. Don't forget, we just launched the initiative with Canvas Credit Union with the mortgage insurance waiver program, and I'm going to put that in the chat for anyone interested. And then one more question is, does any of this information change if you are taking a 15-year loan as opposed to a 30-year loan?
Let's see. What's going to change? Well, your mortgage insurance premium would be vastly different, okay, on a 15, because you're going to reach 80% loan to value faster because you're paying more of the principal balance off faster, if that makes sense. So basically, if you're able to afford a 15-year, you're going to save a ton of money on finance charges. Now, sometimes if a person's a little bit worried about whether they get a 30 or a 15, the suggestion is, you can always get a 30-year loan. And if you pay 2 extra payments a year, 2 full extra payments a year, you'll be paying it as if it was a 15-year. So you can, it's called power pay a mortgage that way. And so then if you hit a bump a few years from now, and that, say somehow you've accidentally lost your job, then you can still pay that 30-year payment until you get that next job, and not miss a beat. But if you can afford a 15-year, it's by far going to save you a ton of money over time. Even one extra payment a year will take a 30-year loan and pay it down to 22. But 15-year loans, they're available on all these products. I think I'd have to double check the USDA loan to make sure they offer a 15. But again, you'd have the right to prepay a USDA loan with extra payments and bring it to in essence, be a 15-year loan if you so chose. I've helped people pull an amortization schedule so they can see, how that can happen by extra paying principal. So
I did include Amy's contact information in the chat as well, if anyone wanted to be able to set up a one-on-one time to go over some things with her. You're certainly welcome to do so. And I don't see any other questions in the chat, so I appreciate you all spending, if this was your lunch hour, spending your lunch hour with us.
yes.
And I appreciate Amy for coming in, sharing information with us, and a special thanks to John Fast for coming and providing ASL interpretation for us today.
Awesome.
Thank you
Thank
all.
you. Bye.